Hello everyone, my name's Paul Conrad and I am a CPA living in Richmond, Texas. Richmond is about half an hour or so west of Houston, Texas. Texas is my home. And, uh, and over the course of being a CPA, being in business for myself for quite a while now, and most of my clients are in business for themselves. They either own their own business, maybe they own some real estate, that's kind of a business too. But over the course of being in business for myself, I have clients who have asked a lot of questions, and I'm creating a series of videos to try and answer some of those questions for them. And today, the topic of this particular video is, what are the tax implications of investing in real estate? I get a lot of questions about investing in real estate, particularly rental properties. How does that work? Do I get a tax deduction for that? And so that's the topic of this particular video. I like to draw charts and boxes and arrows and stick figure people and stuff like that. But before doing that, I'm going to hold up a tax form for you. Now I'm not a big fan of holding up IRS tax forms. For the most part, they're very confusing, and they're just not that good. They're not intuitive when you look at it. But this one's a little different. This one for reporting rental property incomes and expenses is actually a very good form. And so I actually hand this form out to clients a lot and say, this will help you collect your information when it's time to prepare your tax return. So let me hold this up for you right here. What you can see, there's 3 columns here because you can put 3 properties on one form. The important part of this particular form is this part right here, this expenses section right here. What I find happen is people come to me and they go, so I rented out my property, I got to claim that as income, right? I guess my tax bill just went up. And I go, well, maybe, but maybe not. Are we capturing all the expenses? And this part of the form, it acts like a memory jog. And I put this in front of clients and they go, I didn't even think about that. You mean I can deduct that? Well, I certainly have that. Gosh, I forgot all about that one. And I get these kind of funny comments from people, and I say, kind of get to know you once a year, get this form out and go, did I have this and did I have that and whatever like that. And let's make sure we're capturing all the expenses that you're entitled to have, okay? So this is actually a good form. I would encourage you to download that form from the IRS's website and use it. Some of my clients download it, they fill out their numbers, and they hand me the form along with all their other tax information, and I integrate that into preparing the return, and it's nice and clean and easy and saves time, and it's just a good way to go. So to kind of get to know that form. Okay. A lot of clients say, should I invest in real estate because I'll get a good tax deduction? And I go, well, actually, that's the wrong reason to invest in real estate in the first place. You invest in real estate because you think it's going to go up in value. Or you invest in real estate because you can rent it out for more than what your expenses are going to be, and it's going to put money in your pocket. But you don't buy real estate because of a tax deduction, because the way tax law is written, a lot of times you don't get much of a tax deduction for real estate. And I'm going to walk you through some numbers, a good example. We're going to show this to you. But you're not buying real estate for the tax deduction. You're buying it for other reasons. But if you've bought it for those other reasons, well, now we got to report it on a tax return. Okay. Imagine you have this form in front of you, and let's put some numbers up here on my board here. The first thing that's going to happen is someone's going to hopefully pay you to actually rent it from you. Hopefully you don't have some deadbeat tenant or something like that. By the way, people ask me, should I invest in real estate? And I kind of know them. And I'm not really sure real estate is the right kind of investment for them. Now I'm not going to tell them that, but I say, have you ever seen the movie called Pacific Heights? I think that's the name. This kind of old movie. It's probably 30 years old now. But this young couple, they rent a duplex in San Francisco, and they live in half of it, and they rent the other half out to this. They didn't know it at the time, but he turns out to be this horrible, horrible tenant. And he does things on purpose to get them mad at him. He drills holes and he lets cockroaches into the walls. and he plays the drums at 2 in the morning. He does whatever. He's just a horrible, horrible tenant. And the husband of the landlord gets so mad that out in front, he beats up this guy. And that was the plan of this horrible tenant. And this tenant sues the owners of the building and wins because he's been all beat up. And his compensation is he ends up with this property, okay? It's really an interesting movie. And I say this a lot if you're thinking of investing in real estate, because real estate is not for the faint of heart, okay? Especially if you're going to manage this yourself. Now, you can pay someone to manage this for you, and that would be a deduction too, but it's eating into your profit. If you manage this yourself, and I have a rental property, I manage it myself. Thankfully, I've been good enough to have good tenants since day one, actually, but that doesn't always work that way. I have clients who didn't have good tenants, but so assuming that the rental property, you're comfortable with being the landlord, and maybe you're comfortable managing this property too. Okay, that's my little speech within a speech about should you even invest in real estate in the first place. So you rent this thing out, you have a good tenant, and your tenant pays you $12,000. That's $1,000 a month. Okay, you're going to have to report that as income, just no doubt about it. But what can we offset that with expenses? Okay, if you have a mortgage, you're going to pay somebody some interest on that mortgage. Nobody loans money for free that I know of. And every county that I know of is going to charge some sort of a property tax on that property. And if you have a mortgage, and even if you don't, it's a good idea to have insurance, because, things go wrong. They just do. Maybe there's a fire. Maybe there's a flood. That's a different kind of insurance, by the way, flood insurance. But things go wrong. People get hurt on your property. So your first line of defense in a legal sense is have good insurance. Maybe something breaks and you have to repair it. Maybe you're in a neighborhood that has a homeowners association and you have to pay some homeowners association dues to this. I'm not going to write them all out, but maybe you paid a commission to a real estate agent to find you a tenant in the first place. Maybe you have to travel to that rental property once in a while to check up on it, or find a new tenant or something like that. Maybe there's lots of maybes that kind of go on in here. One of the deductions, and we're going to spend a little more time later on in this video, is called this sort of magical deduction called depreciation. And we're going to talk about what happens. You've bought the property, you've kind of fixed it up a little bit, and now you're renting it out, and here's where we are. You're in this rental process right now. So let's say your interest is $4,000. You don't have to keep track of what your interest is throughout the year. Your lender should send you a statement. The interest on the mortgage was $4,000. So just make sure you get that one statement, okay? Some people pay their property tax as part of their mortgage payment. If you do that, that same statement will tell you what your property tax was. It might actually tell you the insurance too. You may have included the insurance as part of your property tax, as part of your mortgage payment. So some people help you keep track of this, but some things you got to keep track of yourself. Okay. Well, let's say the property tax. Didn't write that one very well. Let's say your property tax was $3,000, and your insurance is $1,000, and your repairs are $1,000. Toilet broke, or had to call a plumber or something. Things break. If you've owned real estate, things break. Don't have any dues right now. So in this case, you brought in $12,000, but your expenses, $7,000, $8,000, $9,000. We've got $9,000 of expenses to use to offset the $12,000. So you have, in this case, what I call a calculated profit of $3,000. Just kind of know that if you have a profit, it gets added in with all your other income and you're going to pay tax on it. Profits are always taxed. Now, I intentionally did not include the depreciation on here, but the point is, if you go through this and you calculate that you have a profit, just kind of know there's a tax there, okay? I intentionally left off this depreciation. We're going to talk a little bit more about that. But there's a sort of, it's not really magical. It feels magical till you know where it came from. But let's say that this particular property has $5,000 of depreciation expense that goes along with it, okay? Well, your expenses are not now $9,000, they've now jumped up to $14,000. Now this property is probably putting money in your pocket. You're out of cash $9,000. You're out of pocket, I should say. But you had $12,000 come in. So in a cash sense, you're $3,000 to the positive. But on a tax return, when we add in this depreciation, it's got a negative number here. A $2,000 negative number. So one of the nice things about real estate is, if you're just counting the cash income and the cash expenses, it put money in your pocket. But when you figure in this depreciation, you actually got a negative number here. I don't know that I wrote my 2 very well. Let's try that again. You have a calculated loss of $2,000. Now, the form doesn't use these phrases, but I use the phrase calculated and deductible, and they don't mean the same thing. If this was a positive number, a minute ago we had a positive $3,000 calculated and what I call deductible. Whenever you have a profit, your calculated profit is your taxable profit. Same thing. Deductible. When you have a loss, there's a maybe I get to deduct it and maybe I don't. So you could have a calculated loss of $2,000, but the question becomes, what is my deductible loss right here? Well, that depends how much other income you have on your tax return. And the more income you have in other places, the less chance you're going to have the ability to deduct that loss. Let's say that you're married and both spouses make $100,000, so you've got W-2s of $200,000 in another place on the form. Tax law says when your W-2s or any other income is that high, we're not going to let you deduct that $2,000. So you may have a calculated loss of $2,000, but your deductible loss is $0 because your income in other places is strong enough that it blocks you from deducting this loss this year. It doesn't mean forever, but it means this year. Let's say you're single and your salary is $75,000. That's the only income you got is a W-2 with $75,000. And you have a rental property and you calculate this $2,000 calculated loss. What is your deductible loss? Your deductible loss is also $2,000. So on that tax return, you'd have a $75,000 W-2 income and a minus $2,000 rental loss, and you'd pay tax on $73,000. You actually got to deduct the loss. So the calculated loss and the deductible loss for someone whose income is more modest, they're the same thing. They get to the calculated becomes the deductible. But if your income is higher, too high in our government's estimation of what's too high, they're the ones who decide that, not me. But if they think your income is too high and it's over a certain limit, you may have a calculated loss, but your deductible loss is $0. So do you get a deduction for rental property? My first question is, how much other income do you have on your return? That's really the big input, the big question to answer. And the higher the income, the lower the chance you're actually going to get to deduct the calculated loss. Well, what happens to that calculate? Does it just kind of disappear and it goes away? No, it doesn't do that. I say it goes in your back pocket. A more correct term might be it's suspended or carried forward. So let's say in year one, you have pretty good income and you didn't get to deduct like this. You did not get to deduct your loss. This $2,000, it's gone in your back pocket. Well, let's say in year two, you lose another $2,000, so your calculated loss is another $2,000. You didn't get to deduct it because you still got the strength of those W-2s in other places on your return. So your suspended loss is now $4,000, $2,000 from the first year and $2,000 from the second year, okay? And then along comes the third year, and you came into some money for whatever reason, I don't know, and let's say you paid off the mortgage, okay? Some people do that. Or if you've rented it for a long time, your mortgage, your interest goes down over time anyway. But let's just say for this example, you paid off your mortgage, you got some money and you paid it off. But you didn't pay it off at the beginning of the year. You paid it off kind of towards the end of the year. So let's say that your interest was only $1,000. You did have some interest for part of the year, and then you paid it off, so somewhere in the middle of the year, okay? So what are your expenses now? Well, your expenses are 1, 4, 5, 6, 11. Your expenses are 11 grand. Let's put an 11 here. 11 grand of expenses. 12 grand came in the door. So you have a calculated profit now of $1,000. Are you going to pay tax on the $1,000? No, you're not. At least not in year 3, because in year 1 and 2, you lost $2,000, and that was suspended. You're still going to get it. The question is, when are you going to get it? That's really, these suspended losses, you're going to get them. The question is, when are you going to get them? And you didn't get it in year 1 and year 2 because of the strength of that W-2 you had. So you have $4,000 of undeducted real estate losses just waiting, okay? Well, along comes the third year and you got $1,000. So are you going to pay tax on $1,000? No. What's going to happen is we're going to pull 1,000 of that 4,000 from the prior 2 years. We're going to pull that back out of our pocket, and we can put that on the return for the third year. And even though you made $1,000, you're going to offset that 1,000 with 1,000 loss from the year before, and your taxable profit in the third year is actually 0. So you got to use a prior year suspended loss to offset a current year profit. You still got 3,000 sitting in your back pocket. You had 4, you used 1, you burned up 1 of them, but you still got 3 to go. And depending upon what your expenses are, you may add to that. Or if you're starting to make a profit, let's say you raise your rent, and this is now 14 grand. And you've paid off your mortgage, so this is gone. This is like year 4 now, something like that. And you add all this up, and that's 8, right? 3, 4, 5, that's 10, excuse me. So we're in year 4. So your calculated profit is 4 grand, right? Brought in 14. My expenses are 10. I got 4 left over. But in our example, remember, I had 3,000 in my back pocket of undeducted losses. I pulled the whole 3 grand out, and I can offset 3 of this 4 loss right here, and I'm going to have to pay tax on only $1,000. So after year 4, I've burned through all those suspended losses now. Now if I have a profit, I get taxed on the whole thing. But this is how, most people don't realize. I say, you may not get any deduction for the rental property. And they go, even if my expenses are more than my income. And I say, even if your expenses are more than your income because of the strength of the other income that you have on your return. And we walk through this calculated and deductible. They're not always the same. And how you build up this little pile of undeducted losses or suspended losses. And as you start to make profits, you dip into that undeducted amount, you throw it back on this return. and you burn through all your suspended losses first. Now, when your bucket's empty of all these non-deducted or suspended losses, now if you have a profit, you pay the tax on it. So it's kind of important to know, if I have a rental property, do I have any undeducted losses that have been accumulating? Now, tax software keeps track of this for us. So if I do your return, or any other CPA does your return several years in a row, the software remembers what you deducted and what you couldn't deduct, and it rolls that into the next year. So you don't always have to keep track of this, but it's good for you to know. I've had clients who they were starting to make profits on their rental property, but they had these undeducted losses, and so they were making a profit, but they weren't really paying any tax because they had these losses. Well, then when you go through the loss, now they start paying tax, and they go, wait a minute, I didn't make any more money on that rental property this year than I did last year. Why did my tax bill go up? And I have to go remember those losses from even before that. We've burned through all of those. So each year is now kind of standing on its own. Okay? But this is how rental properties work. And it's a little bit of a surprise to people, this idea of a calculated and a deductible loss. And they're not always the same. Okay, here I'm starting to erase, but I do want to loop back a little bit and talk about depreciation. Where does that come from? Oop. Okay, so before you even rent it out, you buy this property, and maybe it's in good shape and good chance it's not. And you got to throw some money at it to fix it up to entice someone to rent it from you. Okay. Let's say that you paid $125,000 for a property. What did you buy? You bought the land and you bought the house sitting on the land. Now the contracts and the legal things, it might have a tract description and all this legal stuff, but it doesn't say, I can tell you what it doesn't say is, I bought so much land and so much house on top of the land. Contract doesn't tell you that, but that's really what you bought. And the tax law says you got to separate the two between the land and the building. Why do you have to do that? Well, in the tax world, land is, you can't depreciate the land. Depreciation means I bought something and I'm going to spread the cost out over time. That's what depreciation means. A cost at one time spread out over time. But you're not actually allowed to depreciate land because, in theory, land doesn't wear out. Land retains its value. At least that's how the tax code looks at it. So you don't get to deduct the land when you bought land and building. So you have to figure out, well, how much land did I buy and how much building did I buy? And no one tells you this. A lot of times you look at a property tax bill, the last one, and it'll say the land was 80%. It doesn't say 80%. It might say the land was 75 grand and the building was 75 grand and the land was 25 grand. 75, 25. Well, that tells you that the building is 75% of the total cost of the whole property, and the land is 25% of the cost of the whole property. So we'll use a property tax bill and calculate some percentages and apply it to what you just paid for this thing, okay? So let's say we do a little analysis and we determine that of that total purchase price, 25,000 of it was land, the non-depreciable land portion of this purchase you just did. That means you have $100,000 of building or structure that you can depreciate, okay? If you buy the property and you don't make any renovations to it, you bought it and it was in a rentable condition right off the bat and you rent it out, then what we would do is we would take the building portion of the total purchase price, we take this and we would divide it by 27.5 years. Well, that's an odd number. Where'd that come from? I have no idea. That's what's written in the tax code. 27.5 years for the building. My guess is some congressman who wrote the law had a rental property and he needed a certain amount of depreciation, and the way he got there was you depreciate it over 27.5 years, and that's how it got written into the tax code. I don't know if that's the case, but that's the only answer that I can come up with. So you have to do a little bit of math here, but what's 100,000 divided by 27 years? So that's a little less than $4,000. It's you know, some of you are going to check my math, but let's say it's $3,800 a year. So while I've erased sort of my copy of the Schedule E form, it had that one line item for depreciation, and I plugged in 5,000, and you were thinking, where'd that 5,000 comes from? It really comes from this kind of math. And when you first buy a property, we figure out what this split is. Tax code tells us 27 and a half years for the depreciable part of it, that's the building. And we divide the building, our best shot at it, times 27 and a half, and we come up with our annual depreciation. If the first year, if you're halfway through the year and you buy the property, you won't get the whole 3,800. You'll get 1,900. You'll get half of a year that first year, and then it'll be 3,800 each year after that. But this is the beginning of understanding where this depreciation comes from. What is the real cost of the property? If you paid $125,000 for it, it's probably not $125,000, because while the stated price may have been $125,000, you probably incurred some closing costs when you bought it, and you'll certainly incur some closing costs when you sell it. The closing cost might have added another 1 or 2% to this thing. But let's say it's $2,500 in other kinds of fees that are on that HUD closing statement. That's a very important document, by the way. And when I have clients who buy or sell or refinance property, I say, I want to see the HUD statement, because a lot of times there's things on there I need to know. And a lot of it is tax deduction. So if you're using me or use someone else, anytime you buy, sell, or refinance, make a copy of that HUD statement and give it to your tax preparer. It's important information for them to know. But in this case, the real purchase price is $127,500. Okay, because of these are closing costs right here. Closing costs at purchase. Then from here, we may do our land building split, but let's say we'll keep the land at the same $25,000. That would mean that the building is really, our depreciable building is really a little more than what we thought it was. Okay? And we divide that number by 27 and a half years to come up with what our annual depreciation is going to be. Okay? Now this is assuming that you bought the property and you didn't fix it up. It was good. And someone rented it from you right off the bat. I hope that's the case, but it's not always. Sometimes rental properties you buy and intentionally buy a rundown, beaten up piece of property, and you renovate it, and it increases in value more than the dollars you spent to renovate it. That's a good thing. You're creating some equity along the way. So I'll have clients where they'll go, Paul, here's my HUD statement. I bought it for $125. With the closing costs, it's really $127. And I incurred $30,000 to renovate it, put in a kitchen and a roof and a this and a that, and fixed a lot of stuff. He couldn't rent it out. It was all trashed. Had to spend $30,000 to renovate it. Now I'm using the word renovation. Clients come in the door and they go, I spent $30,000 repairing. In the tax world, there's a difference between renovating something and repairing something. But the client comes in and they say, I have repaired this for $30,000. And on this Schedule E, that line item where it says repairs, and I had written $1,000 before, they write $30,000. They want to deduct the repairs, what they're calling repairs, for $30,000. I go, did you really repair this? Well, what do you mean? Of course I did. Well, in the tax world, maybe you didn't. Okay. Here's how tax code distinguishes between a renovation and a repair and how it lands on a tax return. Okay. In a very general sense, if you buy anything, applies to real estate, and you put some dollars into it before you start to use it for whatever it's going to be used for, then those dollars that you put in are actually considered to be part of the cost, not part of the expense of owning this property. Let me say that again. In our example, let's throw some numbers at this, including the closing costs, $127,500, and you spend $30,000 renovating this. So you had to spend 30 grand because in the condition it was in, no one's going to rent it from you. You had to fix it up. And you had to try to make it appealing. And so you renovated. You didn't repair, you renovated. Clients walk in the door and they want me to put $30,000 as a repair bill and show this really big negative number down at the bottom. And I go, first of all, your income, you got enough strong income in other places that no matter what that negative number is at the bottom of the form, you're not going to get to deduct it anyway, because that's involved in, that calculates the calculated loss, but because of the strength of your income, it's not your deductible loss anyway. So even if I did put 30 grand in the repairs, it's not going to save you any taxes because your income's too strong in other places. Okay. Tax law really doesn't even allow you to put that 30 grand on the repair line item before you get a tenant in. See, the depreciable cost of the building, you bought land in your building and then you fix the building. So the depreciable cost is not only what you paid for it, but the dollars you spent to fix it up to get it to the point that you could rent it. So when you buy a property, here's what you need to think about. Remember this, please remember this. When you buy a property and you spend some dollars and you haven't got your first tenant in yet, but you're spending dollars to fix that up, those dollars become part of the cost that we're going to depreciate over that 27.5-year time period. They're not repairs. And I've had clients who are audited and we wrestled around with the IRS agent. What's a repair and what's a renovation? And this particular client had 100 houses. And they were always buying and they were always selling and they were always repairing. And so this idea of what's a repair and what's a renovation for that particular client, it really wasn't quite so clear. And there was a valid arm wrestling match that went on between me and the IRS agent. And we came to some terms that made sense to everybody and we all moved on with our life. But kind of the point is, just because you spend $1 doesn't mean you get a deduction for it. It's not always an expense. So in this case, you spent $127,500 to buy it. You renovated it before you even got your first tenant in. That's 30 grand. So your all-in cost is now $157,500. That's the true cost of this property. Now a tenant moves in, and we have to do this land building split. Well, we've determined that the land that you bought, no one told you this, but we did a little investigation on our own. The land was, because these renovations didn't increase the land, they increased the building that's sitting on the land. The land didn't change. So I'm not changing the portion of the land that we're allocating as the cost to the land. I'm not changing that. But I am changing 500, and that's a 2, and that's a 3. So the true depreciable cost of this property has now jumped from $100,000 up to $132,500. That's the land, that's the building, including renovating the building. This number we divide by 27.5 years. Oh, that's probably closer to about $5 grand a year. I'm gonna guess. I don't know. I don't have my calculator with me. Those of you watching at home can check my numbers, but that's probably pretty close. So when you fill out this Schedule E and there's a depreciation line item, now I'm not expecting you to fill out that line. My software remembers this from year to year to year, and whatever that number is, it's going to plop that number on the depreciation line item, and you don't have to tell me that. My software will remember that. You tell me everything else, the interest and the taxes and the insurance, and maybe you did have a repair. Tenants moved in, and then the toilet breaks, and a plumber comes out. fixes a toilet. The house isn't worth anymore. Can't sell it for any more. You don't get any more usefulness out of it. Toilet's a toilet. What tends to happen is the renovations are the big dollars and the repairs are the small dollars. Renovations happen before the tenant moves in. Repairs happen after the tenant moves in. Sometimes you have something like, I put in a new floor. Is that a renovation? After the tenants are in. Maybe I had 2 or 3 tenants. They've moved out, but before the 4th one comes in, I put in a new floor. Spent $3,500 or something. Is that a renovation? Do we add that to this cost that we've accumulated? Or do we call that a repair for $3,500? That's not always an easy question to answer, and different CPAs probably will give you different answers on that one. You get my point. This idea between a renovation and a repair, it's not always so clean cut. Sometimes you take your best shot at it and go with it. Of course, we want the best tax deduction, but we want this to look normal. We're also keeping in mind the fact that even if it's a loss, you may not get to deduct it anyway because of the strength of your income in other places on your return. I'm hoping this makes sense to you. Important to know the difference. What is the true cost? What is the depreciable cost of this property? So you separate the land and the building. You add to the building the renovation costs. Then you get a tenant in and you start to rent it out. That's a classic model. Life doesn't always work that way, but that's kind of the starting point of the conversation. Okay, so you've owned this property for a while and you go, just time to do something else. Okay, I moved out of state, there's rental properties 1,000 miles away. I just don't want it anymore. Okay, that happens. So you're going to sell it. Well, if you've owned it 20 years, it's probably gone up in value. And there's a tax that you're going to have to pay because you're selling it. Okay? So what is your profit? That's not always an easy question to answer. The clients will walk in the door and they'll go, I bought this for $100,000 20 years ago. And I could sell it for $200,000 now, 20 years later. So they go, almost casually, they go, so my profit's $100,000. And then they go on with their conversation. I go, time out. Your profit probably isn't $100,000. They go, what? Bought it for 100, sold it for 200. I mean, that's easy math, Paul. Come on. Well, there's more to it. In the tax world, there's always more to it. Okay. Let's revise this a little bit. You sold it for 200, but maybe you paid a real estate agent a commission. And there's other closing costs. We've talked about closing costs. Well, when you sell something and you incur closing costs, you can deduct that from the sales price when we throw the numbers on tax forms for you. My experience is that if you use a real estate agent, that normally knocks about 7% off the sales price. There's a sales commission that's 6 or maybe 5%, and there's other closing costs. But I kind of estimate for a client, they haven't sold their property yet, but to think about it, I say, the first thing we're going to do is we're going to factor in an estimated 7% of closing costs. So you may have sold this for $200,000, but you didn't get $200,000. You are going to get, let's see, that's for, so you're going to get $186,000 out of the deal. And they go, well, that's cool. You got me a tax deduction, so my profit is not $100,000, it's only $86,000. And then they go on with the conversation. I go, time out. That's not the end of the story. It never is it? Okay. Explain that to me, Paul. Okay, so hang in there. In the tax world, I know the owners, their approach is, I bought it for 100, I sold it for 200. Tax world, you don't use 100 and 200. You use different numbers to calculate that. On the sales, we figured out that your sale is probably less than what you thought it was because of those closing costs. This is the big number that changes, especially over a long time period. Here's how tax law treats that. Let's say that you were depreciating this at $4,000 a year in depreciation. Okay? You've taken this deduction, You've gotten the deduction on your return. It's not sitting in the suspended bucket anymore, but you've got it. You've taken it. Well, in the tax world, when you sell something, when you plug in what my cost is, my cost starts with this. My cost starts with, well, I paid $100,000 for it. But you subtract from your cost all the depreciation that you've taken along the way. What's left over, sometimes I call it the book value. I hate to use the word value because it's not what it's worth value, but in your little set of rental property books, it's the undepreciated value, the remaining value, or what I sometimes shortcut, I call it the book value. Well, if you've had this property for 20 years and you've taken $4,000 a year in depreciation, well, your undepreciated cost, your book value, you've taken $80,000 of depreciation along the way. So for tax purposes, when you sell, you don't figure $100,000 is your cost. You figure that $20,000 is your cost. In the tax world, we use the word basis. So maybe you've heard that word, maybe you haven't. But basis means what's the cost I use for calculating a profit. That's kind of what the word basis means. And in this example, this guy owns this property for 20 years. And he's taken $80,000 of depreciation. So when he sells it, and his mindset is, I bought it for $100,000. And I go, that's the starting point of figuring this. You start with what you paid for it, but you deduct all that depreciation that you've taken along the way, and the remaining undepreciated amount, that's the number we plug in to figure out what your profit is. So you step back at this and you go, okay, I got $186,000. That came in the door. My cost after all that depreciation is only $20,000. So I have $166,000 profit on that. That's a lot different from $100,000. Got $166,000 taxable profit. Now most of that, a lot of it is going to be taxed at what we call the long-term capital gains rate. Not going to go into that, but you probably get a fairly good rate on some of this, but probably not on all of it. And my advice to clients who have owned real estate for a long time is, if you're going to sell it, talk to me quickly so we can calculate, do a back of the envelope calculation of what the real profit is you're going to have to show on a tax return. It's probably more than what you thought. So don't just take all that money and redeploy it in something else, because you'll have to pull it back out because you're going to have a bigger tax bill than what you thought. Okay? But this is how you calculate profits on taxes. I wish I had time to go into a few other things. A lot of my real estate clients, they sell a property, and if you buy another property within a certain time frame and you use a middleman to do this, you can actually not pay the tax on the $166,000 right now. It doesn't mean you escape it forever, but you push it off into the future. Sometimes we call that a 1031 exchange or a tax-free real estate exchange. It's really not tax-free, it's tax-deferred. There's a difference between free means never, deferred means later. Okay, but if you're a real estate investor and you're thinking you're going to sell something, but you're going to buy something fairly quickly, you're going to replace it. If you do a certain number of things right, you can avoid the tax for now on this. If you sell this property and you put the money in your pocket, you're going to pay the tax. The money goes in your pocket. Even if you pull it back out of your pocket and you buy another property, that doesn't work. Essentially, you have to sell property number one and you give the money to a middleman. And the middleman holds it for you. And then you go buy property number two, and the middleman takes the money that came out of number one property and they put it in number two property, and you never touched it. If you can do that, you can push off taxes into the future. And there's some other strategies that go with that. But kind of remember, 1031 exchanges, you don't go, gee, I'm closing this afternoon. Maybe this morning I'll go research what a 1031 exchange is. You're too late for that. You have to set this up much earlier in the process. But kind of be thinking 1031 exchange if you're going to replace the property with another one. It's a good strategy. Okay. Okay, so that's a pretty good primer on real estate. If you know and remember what I showed you here, you know more than 99% of the people out there, including a lot of people who already invest in real estate. Um, I hope this video had some value to you. Maybe you enjoyed it a little bit listening to it. You learned something that'll save you some money down the road. That's ultimately what I'm trying to do here. Again, my name is Paul Conrad. My website is paulconradcpa.com. Thanks for listening, and I'll look forward to some other videos, and I'll look forward to maybe meeting you at some point. Have a good day, everyone.